Hi all, thanks for joining again. Give me 1 second. Yeah, thanks for joining in. Just give us like 2 more minutes, we'll get started. People are still joining in.
Okay. Good morning, everyone. So thank you for coming on a Sunday afternoon. I know you can be at many places, so thank you for being here and take charge to learn about your financial needs. So here we have a speaker who doesn't need an introduction. So he's a founding member of GATES. So Prabhakar Boyapalli is from Telangana. He's a chartered accountant, practiced in India back home as well as a CA. And he also trained a lot of students to prepare for the CA exams. He is a certified public accountant from Georgia. He's in the accounting and tax services in USA from last 15 years. Prior to being a CPA, he was a CFO of a software company here in America. So we don't want to make any delay. Here we are, Prabhakar Boyapalli.
Hello, good afternoon all. Thanks for joining on a Sunday good afternoon. In America, there are only three things are certain. The one is birth and the death in between the taxes. So if you are in the States, if you're earning the money, and then, there is the taxation will come into the picture when you have the income. So that technically, this is the tax season and you all gathering your taxation information to file the taxes. So what needs to be done is the one of the aspect, how to really prepare for your taxes. One of the important aspect what I learned, the being a chartered accountant and also a CPA in USA, we are all the US citizens or the green card holders or the H-1B holders. We do report our income which has been pertaining to the USA, but a lot of people, they don't really have a lot of understanding as to what needs to be done with regards to Indian income. And also with regards to what needs to be done if you have the money in India, how to really repatriate, what are the reporting aspects. We will shed a little bit of the light on both the incomes of the USA and also the India and what has to be done. A little bit disclaimer, it is only the information purpose. It is not the tax advice. You need to really take the advice from the financial professional or the tax professional whenever there is a need. You know that after January, whenever you're talking about the taxation, there is a hard date as April 15th for individual tax returns. Every individual who has the income, he supposed to be filing the tax return by April 15th. Or if you cannot able to file, at least you have to really file the extension. But when I say the extension, I get a lot of this question. It is only for the extension of filing of the return. It is not the extension for payment of the taxes. In other words, you have the tax liability, some amount to be paid. You can really as well extend, but if you do not really pay the money by April 15th, the IRS will impose, the taxes, interest on the tax to be paid and also the penalty. So what needs to be done in ascertaining the income? Your income is being charged based on your adjusted gross income. Adjusted gross income, it is nothing but your total income per se. The total income which has been consisting of what you call it as the money you said to be receiving. Whenever you said to be receiving the money, the characteristic of the money has only the three ways. The one, either you receive it as a loan, or you receive it as the gift, or you receive as income. Other than that, there is no characteristic of receiving any money, right? If somebody is giving the money, either you are giving him services, or he is giving a loan, or giving a gift. So the loan aspect, we do not really have to worry about it. And the gift aspect, a little bit, we need to really figure it out, who is giving the gift. The main thing is the source of the income, taxable income. And in USA, the technically speaking, the whatever the money which you said to be receiving, which has the checks and balances as to, if you receive the salary, you have a W-2. If you receive the interest, you receive 1099 INT. If you receive the dividend, you receive 1099 DIV. And any other income also, a little bit pertaining to the forms driven. But the aspect is, if you are not really receiving any 1099 or any paperwork, it does not mean that you can get away with that. In the sense of, if you're a, say, consulting person on individual level, you are giving a consulting to some company, if they are not issuing 1099, that does not really absolve you from reporting the income. So there are a lot of people, what they really say is, okay, I have not received the 1099. How and when the IRS knows this? Of course, IRS does not really know it immediately, but whenever they ask about the information, they will know, because you need to really submit your bank statements. So technically, the money, what you said to be received or during the calendar year of 2023, you need to file the taxes in 2024 before April 15th as extension or pay advance taxes. You have to really prepare for filing of your taxes right now. So as I said earlier, you need to really have your own checklist in the sense of what are the things which you really have. You have the salary, your employer will give you the W-2, you receive 1099, dividend or the interest, the person who is paying you will give you. Some of the people who receive the unemployment, the government will provide you 1099G. And the capital gain, if you have a trading account, the Robinhood, with Charles Schwab, whatever you call it as, they give you 1099B. Perhaps it is the only one which has been a bit delayed. All of the documentation, which you will get it by at least by February first week, only 1099. Some of the companies, they do not really prepare, the before February end. They typically give you the last week of the February. If you are going to itemize your deductions, in the sense of you have a home, you are paying the mortgage interest, then you will have to have 1098, which is been given by the mortgage company or the bank. Some of you have the kids and they are going to the college. If you want to really get the benefit of the college fees paid, you need to really get the 1098T from the college. This particular document, it will be there in the portal of the kid. If the kid really logins to his portal in the college, he will get the document. And if the kid is dependent on you, you can really claim it. I get a lot of this question. My kid is going to UGA, I'm paying 30,000. I'm being out of state, I'm paying 60,000. What is the benefit I get? Can I get the deduction? Unfortunately, what is being known as the lifetime learning credit, okay, or the tuition payment credit, which is being subject to restriction based on the income. If you're married filing joint, if your kid is dependent on you, if your income is more than 160, it phases out. And it is in between 160 and 180, it phases out. So please make sure that, if your income is less than 160, you got to really have the documentation. So one of the strategy also, what I typically tell the people is, if the kid is old enough in the sense of 18, 19, anyway, going to the college, if you have any consulting income or you have company income where you are receiving the income on the LLC, if your income is more than 160 and typically you do not really get any sort of the benefit by having that kid in your taxes other than $500. So what typically can be done is, you can really make the kid as independent taxpayer. Even if he's independent taxpayer, still he can be on your dependent in your insurance stuff like that. That is, there is no IRS does not really, or the insurance company cannot really say that he cannot be your dependent. The test what they really say is whether you are paying more than 50% of his expenses on a yearly basis. So you can really make the kid independent, pay the money for the work what he's going to do for your LLC. Then at least you can really save that $2,500. So just make sure that whenever you are filing the taxes, assess your individual LLC income or this corporation income and plan accordingly. The one of the aspect also, if the spouse or husband and wife, they are working, if the kid is less than 12 years old, and if the kid is going to after school daycare, you do really get a sort of benefit. It is not much. It is around $600 per kid for the money what you are really incurring. So I get this question. What they really say is, okay, I'm paying $12,000, and what is the benefit? I mean, unfortunately, the maximum benefit you get is $1,200 for 2 kids. But if you're participating in the FSA account with your employer, even if you are paying the money from the FSA account, you give the child care or the daycare expenses to your tax preparer, because though you paid from the pre-tax dollars from your employer, still that is reported under your W-2 under the box 10. So if you do not really input that particular child care expenses, you will lose that credit. So you make sure that you have to provide that particular the receipt to your tax preparer, or when you're preparing your taxes, you need to have that federal ID number and the amount to be paid. Earlier, it was simple. It is every year the compliance as to the reporting, as to the exact the person to whom you paid, how much you paid, is becoming very norm with the IRS. So make sure that you get a receipt and it has a federal ID number also. You are aware of the fact that a lot of us, a lot of people in consulting arena, they are really doing the consulting work, and if they are doing under your individual name, which should not do that. I mean, provided if you're doing it under the single member LLC or your individual name, you will get your 1099 NEC, net employee compensation. That's what they call it as. So that's nothing but the consulting income. So the consulting income, if you are really receiving either on your individual SSN number or on your LLC, under that LLC where you are only the member, you need to really input that information under your personal taxes. There is no separate tax return to be required, which has been called as the Schedule C, income from business or profession. So one of the aspect of it is, whatever the money which you said to be receiving under the 1099 NEC, that is subject to your Social Security and Medicare taxes, which has been 15.3%. That means you are the employee and you are the employer in this case. So you got to really pay that amount. Of course, under your other W-2, where you're receiving or you're having the threshold, the more than the threshold of Social Security, you don't really pay, but typically you end up paying the Social Security and the Medicare taxes on your 1099 NEC on the net income. Apart from that, the NEC, then you have the rental income also. The people who have more than one home, or the home which they lived in, they moved to the next home, or you're buying the rental property homes, you need to really have a clear-cut information as to what the money which you're receiving as to the rental and what are the expenses pertaining to it. It is very simple for the information which you need to really provide. The rent received, mortgage interest paid, real estate taxes paid on the rental property, and insurance, or if you have really given any commission to anybody to get that rental, and related expenses, all you can really take. It's very simple, but you need to really compile on a spreadsheet so that you are aware of the fact. The one of the advice what I always give to my client is, it is not inputting of the information into the tax return. It is very simple spreadsheet, right? I mean, anybody can simply input and say that these all are my expenses, but you need to really think of, when IRS asks for it, what sort of the explanation you have. That is what more important aspect. It is if you say that, okay, I am traveling to have this property, so you need to really compile your when you went there. Say your rental property is in, say, Florida, you went there, and of course any income you are earning, expenses pertaining to the income is always deductible. So you are incurring the expenses in order to earn the income, they become your expenses. You can really take them. But the aspect of it is how better you can really prepare yourself for the evidence part. That is what very important. When you have the rental income, you can depreciate the property also. And one of the question I always get before the depreciation, if you are lived in the home and you are moved on to the live in your next home, you aware of the fact that if you are lived in a home in the USA for more than 2 years, whatever the capital gain, and more than 2 years as a primary home, whatever the capital gains in this case, which is being defined as your sale price minus your cost price. Just take it as that is exempted. But the one of the main important aspect you always have to remember is, you lived in 2 years, you moved on to the next home, you have to really sell that home within 3 years from the date of moving. What the law says is, from the date of sale, you go back to the 5 years, at least you should really live in 2 years. If you're not living in that home for more than 2 years in the last 5 years, then exemption has been gone. So one of the aspects which you always have to really remember is, if you're taking the guess, or you're taking the decision as to whether you need to really sell the property or keep the property, you need to consider the fact of whether it makes sense to keep renting it out or selling it out. Because if you keep renting it out, then what typically happens is, whatever the capital gain after 3 years from the date on which you moved in, that will kick in 25% of the taxes. 1/4 is gone of the gain, whatever you call it as. So these things which has been really important. So what I suggest is, before you going to your tax preparer, you prepare a sort of a cheat sheet for yourself, stating that what are your income, W2, spouse income, your W2, and 1099, what are the 1099s you have. At least the controlling sheet what you have, then you will know that what are the things which are missing. So the people come to me with a loose paperwork and just they give it to me and say that, okay. And then after going home, they remember that they did not really provide everything. And to be honest with you, the people really, sometimes they don't even give the W2s because they have the multiple jobs or the job after jobs. So at least you prepare a spreadsheet stating that what are the things which you have, so that you will be knowing that what are the things which you need to really prepare. Either you do it for the TurboTax or do it, with the CPA. But I strongly suggest, whosoever the professional earning some income other than only one W2, which has been say 120K, you always seek the professional advice to file your taxes, because there are fine things which you do not really know. Of course, there's a cost associated with going to a CPA, but your benefits always overweigh your cost. Even in the rental property also, you will not be really knowing what needs to be done. So I suggest that you seek the help of the professional when you are really filing the taxes. The last bullet point as to the India income. I am not sharing the screen. Oh, sorry. I'm sorry. My apologies. So you could have told me before, man. Okay. Now, is it shared?
No,
Sorry.
I thought that just you are explaining.
Now it is shared?
No, we are not yet see.
Oh, I'm sorry. 1 second. I think I need your help here. I said share the screen.
Share the screen. Yeah.
Yeah, this one here, and this is the presentation, right?
Yeah, you can just share that. Right. Share. Just click on that. Yeah, I think you should pick up now.
You're okay? You guys see that now?
Yeah.
Yes. Yes.
Okay. We have not been, it's only the second one, so that should be okay. So it's been shared, right?
Yeah, we can see the screen.
Slideshow.
Yeah, it is good. It's good. It's readable.
Yeah, we can see Prabhakar.
Okay, so sorry. So the rental income aspect, what I told you is, at least you compile the information and everything, so that should be the good enough. The one of the important aspect which I always get a lot of questions, and the people who are here for some time, getting the green cards, getting the citizenship, or even on H1B also. The once you are living in this country for more than 182 days, you become the tax resident. It is as simple as that. The income tax or the IRS does not make any distinction between the H1B or the green card or the citizenship. That means there is no different rules applied to the people. But whatever the income which you said to be having in India, that all counts as the income of the USA also. But the thing is, if you're paying the taxes in India, you get the credit for the taxes what you pay. Because the India has the double taxation avoidance agreement with USA under Article 92. So the taxes what has been paid, you can really get the credit. But the one aspect which is really important, you get the tax credit for the taxes paid in India only at the federal level. There is no tax credit for the state level. Say you are a resident of the Georgia, you have a capital gain in India, you pay the 20% taxes in India, while reporting the taxes in USA, you get the credit for the 20% taxes. And of course, there is a different set of some calculations which are there for the federal level. You get the credit, majority of it. But when it comes to the state, you will end up paying the tax. Unfortunately, you pay the tax at 5%, whatever it is. So simply, as I told you, that is the Indian aspect, which we will cover a bit later. So individual tax filing, how to really go with it. You're an employee or you're an individual working on 1099 as self-employment, or you're self-employed under your LLC or this corporation. The benefits as to having a S corporation, what needs to be done, that I'm not covering here. Because that is an entire different set of the structure, what needs to be done, how to structure the S corporation, and what are the salaries to be taken, what are the things which can be done with regards to the 401k. Those all things are which are different. That we will I will not be really covering. But what I always suggest to my client is, if you are having the consulting income where you're receiving the money on your LLC, it is always better to have a S corporation as to the tax planning. That we will discuss when it is required. Okay. The one of the aspects is the tax savings. I get a lot of the W2 employees filing of the taxes with me. What they ask is what can be done. My answer always, unfortunately, what I really say is, unfortunately, it cannot be done anything. Earlier, prior to 2018, there is something which has been called employee non-reimbursement expenses. That means you're incurring the cost in order to earn the income for your employment. That means you have to really improve your skill set. You need to really travel where your employer is not providing anything. You're going for a training, you're commuting, you're having a attire, you're having a dress code. These are all expenses you are incurring that used to be deducted. But the post 2018, this is gone. So if you're a W2 employee, what are the tax saving aspects which you have? One of the important aspects for the W2 employee is your employer provided the tax savings. Typically, they run into the three categories. The one is your 401k, which has been offered by your employer. The second one is your HSA. That is also sometimes offered by your employer if you are under the high deductible plan, or your FSA. Whenever a flexible spending account, whenever which is been applicable to you, you please participate there, because that is the only way you can really save the taxes while you're on W2. There is nothing more can be done, unfortunately. So participate there, get the benefit so that your taxation will be less. One of the other important aspect of it is, if you're working, your spouse started working, please make the changes of your withholding. So what I really see is in the first year, when the spouse started working, the W4 withholding, which really calls for information as to what you're earning, what your spouse is earning, so that adjustments can be done. But a lot of people, what they say is, the first checkbox, what it says is married. Second checkbox says how many dependents, and they simply say submit it. So in other words, what you're doing is, you are taking the dependents and you are taking the married table, and you are paying the less amount of the taxes when the payroll is being processed. Your spouse is also doing the same thing. But when it really comes to the filing of the taxes, is married filing joint, right? So it is not at par. It is the income sits one top of the other. So you ultimately go into the second bracket. So you make the changes, you ask your CPA, or at least what I always say is, if you cannot really put up all the information which has been really required to put in as to the W4, simply say if your spouse started working, say single with one dependent, you and your wife also say single and one dependent. The reason being, by saying you are single in a W4, it is not making you single. Let me make it very clear. So it is only for the withholding purposes. It is only withholding purposes, and when you finally file the taxes, then ultimately you will file married filing joint. If you are not participating under the 401k, then you can really contribute to the regular IR, which has been, the 6,500 or 7,000, whatever it is, that which is always subject to the limitations as to the income. And if you're participating under your 401k, that is gone. You cannot really do that. One of the important aspect, which we tend to not to look into, is the Roth. As you aware of the fact that, there is a lot of difference between the regular IRA and Roth IRA. Regular IRA is pre-tax, Roth IRA is the post-tax. You can contribute either to regular IRA or Roth. You cannot contribute to both. That means the limitation as to the 7,000, which can be only either regular or sub or 3,500, this one, in whichever way you put it in. If you're participating under the 401k, if your income is more than the threshold of, I forgot the number, I'm sorry about it, 210 or 206k, you're not eligible to put the money into Roth, even if you are not participating in the 401k or participating in the 401k. But what can be done? I mean, a lot of people come to me, I want to really put the money into the Roth. The safest and best way is always, instead of really going through any of aspects of it, is put the money into the regular IRA and convert that into Roth. Because if your income is more, if you are putting the money into the Roth, that is not exempted when you withdraw the money. You will pay the taxes on that. But if you put the money into the regular IRA and convert that into Roth, then there is no taxation when you withdraw the money. And you may really heard the term of the backdoor, right? That is the backdoor IRA. That is what they call it as. It is any income or anything, it does not really matter. Simply you can put the money into the IRA and convert that. One of the strategy which I always have to, we are all the Indians, we are all from the state where we always believe in build up the wealth by way of the properties. Nothing goes out of our vision when it comes to the land and building, right? We are especially from Hyderabad and Andhra Pradesh or Telangana. But you can really build your wealth for your kid by start contributing into Roth. Have this strategy. When they are young, 7 years, 8 years, 10 years, 11 years, open up a Roth account to them. But simply you cannot put the money into the Roth unless they have earned income. Create earned income for them. How do you really create earned income? If the kid is old enough, around 12 to 18 years, you can really have them work for you. If you are having a LLC, you're having a S corporation, they can work for you. You can give the money to them. But you do not really have any of the other sources to the income. Like you're not doing your W2 employee. Still, you can really pay your kid by helping or doing the chores at your house. So create that income to the kid, open up the Roth IRA and put the money into the Roth. It need not be a lot. Start with 4,000, 5,000 a year. If you contribute when the kid is young, assume that when the kid is 15 years old, he has 60 or 70 grand in the Roth, and assume that what that will make in the compounding rate after 30 years. It is a lot more than what you really accumulating your wealth by putting the money into the buildings and lands. So think of that. And of course, the 529 plan, it is only the tax benefit at the state level, but important aspect of it is it grows tax free. There is no federal benefit to it, but at least that grows tax free. So take care of that also. I mean, you can contribute per kid per parent $4,000. You can contribute more also, but you do not really get any tax benefit. And electric vehicle nowadays, the Tesla, everybody bought the Tesla, so you will get the 7,500 provided your income is less than 300K. AGI is less than 300K. But you need to really understand it is not only in the year in which you really buy and says, for example, you bought the vehicle in 2023, they compare the income in 2022 also. So your 2023 income is more than 300K, but your income is less than 300K in 2022, still you contribute. And solo 401k for S corporation LLC is very important, where you can really accumulate a lot of money there. That is the pre-tax, so that you can really save the money. Okay. Okay, this is what I was the saying about without looking into the slide. Employees working under the W2 should maximize the contribution. Home office business deduction for only business income. If you're I get a lot of this question, oh, I'm working from home, I'm employee, what do I do? You cannot really do anything, unfortunately. Salary is paid to the minor kids, what I told you about your Roth IRA, that is very important aspect, you'll take care of. Then usage of the vehicle for the purchase, if you have a LLC, if you have a S corporation, always consider, if you have the income, always consider the buying of the vehicle under the company name. People come to me and say that, okay, I bought under my name, I will take it in the business. Unfortunately, you cannot. You cannot depreciate the asset which is not belongs to the business. The asset is yours. You can really take maybe the miles or maybe the rental value, but you cannot really take the depreciation. And also, the one of the important, the people call it as the Augusta rule. You have your home and you have your business. If you are using your home for the business purpose, of course, the IRS says that you can take up to $1,500 deduction in a yearly basis, no questions asked, for 300 square feet. But you are renting it out, your home for your business purpose, not on the regular office usage. In the sense, you have a consultant for you coming to your home, or you have a seminar, put it in your home. So your business can pay to you as rent. If your business is paying the rent to you, and in a layman terminology, what it is been known as, there is expense to the business, but there is the income to you. Don't take me wrong. There is income to you, right? I mean, one expense to somebody is somebody's income. So if the business is the expensing it out, that is going to be your income. Your employer paying a W-2 salary to you, that is expense to him, and that is income to you. Likewise, you're renting it out, your apartment, that is income to you, and that is expense to somebody. Here also, you can really give your home to the business for rental, provided you use that only for less than 15 days, then there's nothing to be reported. That is called as the Augusta rule. But you need to really have the proper documentation when you let out or what it is being done. And the IRS asks these all questions. This is primarily the US. I mean, we have the lot about the USA, but this is primarily, that is what I thought. Due to the time constraints, I did not really put a lot of information also. With regards to the Indian income, Indian income as a US citizen or the resident, you got to really put in your personal taxes. There is no if and but rule. But if you are having the income in India, what needs to be done? Again, what I always suggest is engage a CA in India so that you are complying with the rules and regulations, what is been pertaining to the Indian laws. So the applicability as to the Indian income is, if you are living more than 180 days in USA, you become the tax resident, then you got to really pay the taxes for the income which you are earning in India. If you are not obtained any PAN number, I strongly encourage to get the PAN number in India, because if you are having the income, you need to get the PAN number. Other thing is, like our April 15th, the taxation is, you need to file the tax returns before July 31st of every year. India, as you know, that it maintains not the calendar year, it maintains the fiscal year. Fiscal year starts from April and ends in the March. Okay. So engage a CPA and see that what needs to be done with regards to the Indian income. It is the same concept as to the income. Either you call it as the USA or you call it as the Indian. The concept wise, it is the same. You have a salary, India, you have a salary. You have a rental property here, you have a rental property in India. You have business income here, business income there. You have interest, you have interest. Only terminology wise, they call differently, and the forms wise, they are different. That is the only difference. Here you call it as a W2, they call it as a 16A. Here call it as a 1099 DIV, they call it as Form 16A. So that is the only difference as to the forms. You are called the interest income, they call it as income from other sources. So the technically income from house property, business, salaries, the categories as to state as the 5 categories: salary, interest, business, capital gain, other sources. Everywhere it is the same. But the treatment, it is a bit different as to the taxation. When you really having the income in India, you need to really file the taxes. You pay the taxes in India. As I said in the earlier also, you pay the taxes. Once you pay the taxes, you get what is been called as a double taxation avoidance agreement. You can really get that under the forms 1116. So the make sure that whatever, technically speaking, you need to compile your 12 months of the income and see that what are the taxes paid in the last year. So IRS takes into the account of, though the calendar year is different from the fiscal year, you can compile for the 12 months, but the taxes paid in the 2023, you can really take the credit. That is what typically they say it. So what I strongly suggest to you all is, don't ignore the aspect of the reporting the income in the USA for the Indian income, because the regulation wise, if not now, in next 3-4 years, if you know the fact of, due to the double taxation avoidance agreement, Indian government will share your information to the IRS in the future. If you know that a lot of people started asking your social security numbers, whether you're a non-resident, you're earning the interest. So if not now, in next 3 years, for sure, they will share the information. So make sure that you are reporting the income. Income reporting, the part which is very crucial for the next slide, that is the HEBAR. People have the bank accounts, people have the shares, people have the provident funds, people have the lot of transactions which goes on to India. But out of the tax returns what I file, only 5% people come forward and say that I have a bank account in India which has been more than $10,000. Not reporting the income, which will make IRS to re-evaluate your tax return, impose the penalty and the interest. That is very straight, very simple. But having the bank account, not reporting, it is not as simple as that. They impose the penalty of the maximum balance at 50% is the penalty, but they do not really go to that kind of the extent, but at least you're talking about $10,000 penalty. So though if you have the bank account, what I strongly suggest is just go to the bank account, see that what is the balance which has been left, and then we'll go from there. So what are the financial interests, what you're really talking about? So HEBAR needs to be reported based on the bank account balance in any institution, or your cash value of the life insurance policy, or the cash value of the provident fund. And you're having a bank account where you do not really have the ownership, but still you need to report if you have a signatory authorization on that. So make sure that, but again, it is only reporting. Don't take me wrong. It is only reporting. There is no taxation for this. It is only reporting. So please make clear that, just let your preparer knows that you have a bank account that needs to be reported. So this I get a lot of question this, I mean, I have the land, I have the agriculture land, I have the real estate property, I have these all things. Do I need to report the bar? A bar talks about only the financial interest. Does not really talk about the real estate. Okay. So it does not talk about your cars, does not talk about your jewelry, does not talk about the land, does not talk about your agriculture land. Does not. That is a different kind of a thing. The income has been generated by that. There is something which has been fatka, but you don't have to really worry on that. We are not covering on this, but at least the bank account part, just make sure that you start really reporting it. EBBAR not reporting, which has been considering it as the willful and the non-willful. What is willful? What is non-willful? How do the IRS makes the distinction as to the willful and non-willful? You have a bank account, it is running account, you sending the money, you're using the purpose, and there is some money which has been going to your expenses and some money which has been coming back. That part is okay. But what's happening here is you are not reporting that bank account. That part is okay because you do not really know that needs to be reported or knows that, but you are negligent. That's okay because the money is not much of the money is not there. Simply you're using the IRS says that okay, you are a non-willful. What is willful then? You got say the 2 crores, 3 crores, 1 crore deposit, but you're not really reporting any of the income in the USA taxation. So that they term it as the willful. That means you're hiding your income in India by way of earning the interest or anything. If you're not reporting that becomes willful. So the quantification of the transactions and the magnitude of the money which plays a clear role in this. Okay, so that is what very important aspect of what is willful, what is non-willful. So, and in also, it is only the civil penalties of the money, but there is maybe the criminal penalties. So again, I urge or strongly recommend you to report your foreign banking transactions to the IRS. A lot of people have not done their bar. What can be done? The interesting aspect is still you can really do it now also for last 6-7 years or 5 years at least, or 3 years at least. If you have the income, just go back to your previous tax returns, amend the tax return, report the bar. It is as simple as that. IRS does not really question anything. But if the IRS asks you to file your bar, then you are not in a nice place. They might really thinking of really imposing the penalty. So if IRS has not been contacted you to file your foreign banking, then you are okay. Still, you can really go ahead and do that. That is the remedy which I always tell you guys. Repatriation of the money, which is also, I get a lot of the information, a lot of things which people ask me, how to repatriate the money from India. See, the India accounts, which has India NRE account, India NRO account. The money, what you really send from here to NRO or NRE, it can be repatriated back, no questions asked, right? It's simply, if it is NRE, simply on your own, you can transfer back. But if it is under NRO, because the money converted into the rupee, and then the money which has been there under that, though income which has been earned, you can repatriate back, provided the same money, you have not really used it for anything. So how the money can be repatriated? The first of all, as I told you earlier, as to the taxation, the money is having the characteristics of the money which has been there under only 3 characteristics. You receive as income, You receive as loan or you receive as gift. So the receive as income. Again, the Indian context, the income. What is the income? The income as to the salary, income as to the interest, income as to the house property, income as to the sale of the land. So these are all things which can be taken into account, or that money can be repatriated very easily. But the guideline, what it says is, you need to really pay the taxes in India first. Because the RBI or the FEMA restrictions, what they really say is, without really payment of the taxes, you cannot repatriate. So I was ahead of the one slide. All the money which is being created in RO, which can all be repatriated, that is what I told you. Any money which is being send it for purchase of the properties which you are selling it, that also can be repatriated. Only the limit is $1 million per year. If you're selling the property and where you can repatriate after selling and paying of the capital gain tax. But whenever you have these incidents, under the taxation, the one of the aspect which you always have to really remember is, there is no the point of assumption. The taxation or payment of the taxes, which is based on the facts. So don't do anything under your assumption. Internet says a lot of things. It can give you the wealth of the knowledge. It can really give you the lot of information which is not required also, and which can really make you confused. So when you're really talking about the money which has been really running into, the lot of the crores or anything, engage a professional in India before you do anything. Talk to the people, and then only you do it. One of the biggest problem what I really see here as a CPA is, the people do the things based on their own knowledge, based on their own expertise, and they come to me to fix it, which is not warranted, what I would say. Of course, is the consultation, is the cost related, everything which has been cost related. But you need to always weigh in your cost as against the benefit. Everybody knows everything, but only some people, they do that for a living, right? So you need to really go to the person who knows it better, so that you can really use your expertise where you are expert. I'm not saying that I'm an expert, but at least because I do it on a day-to-day basis, so I know that what needs to be done. So don't assume, don't go as per the hearsay. Of course, always people say, my friend said, my internet said, somebody said. These all are, to larger extent, they are not true. They are not 100% accurate, because it's all about the hearsay, and things will not be as it has to be done by a professional. Okay. Again, the one of the important aspect which I want to really tell you is, if any of the properties, it's a sort of the important, just to understand, if any of the properties which are there under your parents' name, don't transfer it to you immediately, and if you intend to sell. Because if you intend to sell or selling within, say, 6 months or anything, what typically happens is, you pay the taxes in India, and again you pay the taxes in USA for the difference, and you pay the taxes in state. But if your father, mother, or somebody, or your brother, or somebody is selling the asset, they only pay the taxes in India. That money can be given as gift to you. Per person, per year, 250K. No questions asked. Since you are receiving the money from the non-resident alien who is Indian citizen, There is a specific form to be submitted with the IRS stating that I received the form number 3520, I believe, I don't remember, saying that I have received the gift from somebody else. With more than 60,000, just you need to really file that form. That's it. No taxation, nothing which has been there. But if the property which has been inherited, which is under your name, you are selling it, then you pay the taxes in India, you report under the USA, you get the tax credit from the taxes you paid in India, and you pay the state taxes. And after you payment of the taxes in India, the money can be repatriated. Any bank or any manager, any RBI, they will not let the money which transferred to you unless you pay the taxes. That is very, very important. So if any relative is going to give to you, simply you can really take it because there is no reporting aspect for them in USA. But if you are a US citizen, if you're receiving more than 60 grand individually, then you got to report. For example, your father, mother, brother, sister, somebody has the known sources. Simply they can really give the money up to 50,000 per each person. No questions asked. Nothing need to be reported. So make sure that, once you are talking about the taxation and any property which you are really selling in India, which has been accounting for a lot of money nowadays. But here I'm talking about only accounted money. I'm not really talking about the cash money, which I don't know. Okay. So it is only the money which has been hitting your bank where you're reporting there. Again, this is what I was telling you. You have to pay the taxes, then only it can be repatriated. The maximum amount transferred from the NRO on sale of your residential property, it cannot exceed more than 1 million. This is what 250,000 under the liberalized remittance scheme that can be done pretty easily. Okay. So, but engage a CPA in India or CA in India so that you don't end up paying the taxes. The one of the important aspect which I always have to really remember is whatever which you are really reporting under your taxation in USA, you got to really have the evidence. I mean, simply evidence as to the expenses is very important. If any money which has been hitting your bank account, you need to have the source. Why you have really received that money? You need to really know that fact. If the money which you are really received, if you do not really have the explanation as to why you received, then either in India or anywhere in the world, they will treat it as the income. It is as simple as that. So the credits coming to the bank account, very important. You need to really state that why you received the money. Okay. And when you are taking the expenses as to the receipts you need to really keep. When the IRS asks for the audit, they ask about, of course, the 3 years. They see the bank accounts, they see all the accuracy of the bank statements and the accuracy of the return. Generally, we receive the mail audit in the sense of there is a discrepancy between what you reported under your income and what the IRS has. So this is, for example, you have 1099B where you are not reported the stock transactions. IRS says that, okay, please, this is what we are proposing. Either you amend the tax return or pay the taxes. So basically, based on your amendment, they accept it. That's very simple. It's the only discrepancy between the information what the IRS says and what you reported. But the in-person audit is very complicated in the sense of they go back to the 3 years with the current year and the last 2 years and they review everything. So please take this very seriously in the sense of there is no scope for imagination in the taxes. Everything which has to be based on the facts. So when you report something as to the expense, try to substantiate it. And I get a lot of questions, a lot of information about the people come and say, do you give the estimation as to the refund? still I don't really understand what to the estimation as to the refunds, because the tax returns based on the facts. The facts cannot really change. So if somebody who is giving the estimation to you as to the refund, don't file the taxes with him. I'm telling you. Because in order to get you more refund, they do the things which you do not really aware. And when it really comes to the audit, you cannot substantiate anything. And regarding these questions, I get it. That's why I'm put it there. What is the benefit of married filing joint or married filing separate? As by my experience, I always can say it's always married filing joint is more beneficial. Interest paid on the foreign home, which can be taken as deduction in USA also. So, but since they don't have any 1098, you need to get the certificate from the banker. Deduction under the travel, if you are going to India, if you have a business, you can establish the nexus between your business and the travel. You can always take the deduction. Depending parents who are living or coming to USA, if they live in the calendar year for more than 182 days, you can really claim. Marriage expense, gold expense, all other miscellaneous ones, they do not really have any place in the taxes. So what it is been there under the code, those are the things only which you can really take. I'm opening up a company. Can I pay my company using my own office? I told you about the Augusta rule. I told you about the $1,500 which can be taken into the account. Can I book the tickets from my in-laws parents? Again, if you can really establish the nexus between your business and their visit, you can really claim. Private school fee, nothing can be deducted. You cannot really do anything on that. Payments made to the personal credit card, if they are used for the business purpose, you can really always claim them. NRI interest, if it is exempted anywhere, that is not exempted in USA. That means agriculture income has been exempted in India, but that is not exempted in the USA. Please make a note of it. You have to really pay the taxes. Down payment for the residential home, spouse, individual working. As I told you, withholding need the adjustment. And do you have to keep the receipts? The answer is yes, if it is more than $75. That's it. I think I covered pretty much what has been on, required to file the taxes onto the overall thing. And if you have any questions, please, you can send me an email and then we'll go from there. Thanks a lot.
Thank you. Thank you, Prabhakarana, so much for giving a brief detailed overview. This is Sandeep, and I would like to present you. Give me 1 second. Right. Hi, this is Sandeep, current president for Greater Atlanta Telangana Society for the year 2024. And we have been, thank you all for attending on Saturday. And personally, Prabhakarana has been here for over 2 decades now, and his office is physically present in Atlanta. One suggestion I would like to add is be careful when you share your data with the CPA companies. There are a lot of fraud companies out there, and they have been selling data left and right. So I sincerely suggest, even if it's a little more expensive, choose one that is near to you and who you can rely on for when you get into trouble. There are a lot of companies who do it for cheap, but at the end, once you get audits from IRS, there is nobody to even answer your calls. So please do consider that point. And as I said, Prabhakarana is physically present here in Atlanta. His office is here on 141, so it's closer to everybody. With that said, I want to kind of highlight one more event that's coming up starting soon. March 1st, we do have a 1 million step challenge. So I encourage you all to keep focus on your physical fitness as well. As we are aging out, we are seeing, with the food that we are eating, we definitely had to take care of our physical activities as well. So I sincerely kind of request you all to join this along with us. With that said, I would like to cover like few details about our main signature events. The upcoming major event is going to be on June 1st, which is Telangana Cultural Day. That's our signature event, and it's going to be our 10th Telangana Formation Day anniversary as well. So we are celebrating it at the coming fairgrounds on June 1st. So, and then August 11th is our Vanabhojanalu event. We'll kind of like mention the event space, like, once we reserve that. October 6th is going to be our major Batkama event across in like coming Alfreta area. Then also we are planning to host one Batkama event in Hindu temple as well. So we'll share the details once it's confirmed as well. Thank you all. With this, I'll hand over this to Praveena Garu so that we can go through the Q&A sessions. And once again, thank you, Prabhakarana, for your time.
Sure.
Yeah, Praveena Garu is like right with me, so I'll hand it over to her.
Okay. So what a beautiful session, Prabhakar. Thank you very much. Very informative. I have like notes which is filled up. We have a bunch of questions. I'll go one by one. The first one is it required on the withdrawal of disbursement of ULIP funds?
Requirement of ULIP funds. You mean, I do not know what is that, to be honest with you. You mean the insurance, the funds which you are really taking as a loan?
Whoever asked that question, if you guys are available, can you please expand it?
Yeah, let them send the chart, then I can really think of next question.
Yeah. Okay. How can I lower my taxes? I have an S corp.
So the S corporation, as I told you, which was really is a very the greater tool for the lowerment of the taxes. Technically you can really process the payroll for some of the sum, and out of the sum which you can really contribute to the solo 401k, and you are the employer also, you can contribute up to 25% of the salary what you receive. And if your spouse is not working, she can be employed with you. There are so many strategies which really benefits the S corporation owners. And a lot of people who are with me, I mean, based on their S corporation, the solo 401k for last 6-7 years, their fund has to, the retirement fund has been substantially the increase. So if you want that, any session, or you can really come to the office, but not now. Now the time is gone. Before the tax season, I cannot really suggest, because that has to be done before the year end. So if you have any questions, you want to really meet me as to the strategies to lower the taxes for this corporation for 2024, you can come and meet.
Okay, next question. There is no income in India. Do you still need to file taxes in India?
No.
As an NRI?
No, the taxes will be filed either in India or anywhere, only based on 3 conditions. The condition 1 is whether you are expecting a refund, then you need to file the tax return, obviously. Or you owe the taxes, you need to file the taxes. Then in USA, there is something which has been called, if you have any self-employment income, which has been more than the $600, you need to file that. $400, you need to file the tax return. So there is no need to file if you do not have the income.
Yeah, actually that question says if you own a couple of real estate properties.
No, unless you receive the rental real estate.
Okay. I have shown my wife's Canada income last year. This year also, I have to show, question mark. I have GC, but she doesn't. I have applied for family-based immigrationship.
Yeah, so technically, if any person who has been entering into your taxes, if the spouse, though even if the spouse is not working in the USA, by virtue of adding her as your the tax return, joint tax return, as a USA resident, then you got to really pay the taxes for the whatever the income which has been arised accrued in other countries, but you can get the credit for the taxes what you paid in other countries.
How is the taxation here in USA for transferring money?
Transferring money to who?
I think I'm guessing that money is coming from India.
Yeah, I mean, if the money is coming from India, first of all, as I told you, the money can be come only under the three sources. The source one as the income in India. If the income is in India, you pay the taxes, then repatriate, you report here, you pay it, you get the credit for the taxes, you pay it. That is step one. Step two is, somebody is gifting, there is no reporting aspect if the income, if the money which has been less than $60,000. And in the loan, there is no reporting required.
Next question. Just upgraded to a new home and a couple of months later sold my old home where I have lived for last 5 years. Can I still carry forward my capital gain to the new home?
There is no carry forward. The income, whatever is the income which is being incurred or occurred, capital gain, that is exempted. There is no carry forward, right? Simply your self-acquired prop, you're lived in the home for more than 2 years. The difference between the sale price and the cost price, not the loan value. It is the cost price, whatever is the delta, that is exempted. But make sure that you report it. If you are not reporting, the IRS will send you a bill. So make sure that if you are selling your home, and just you need to report it under your taxes as the resident in which you lived in. Okay.
Next question. From an LLC perspective, are Roth contributions towards our kids' accounts made before taxes? Are they pre-tax or post-tax?
No, post-tax. It's always post-tax.
Okay.
Kid has to have income, right? How the income is being generated from the LLC. If the kid is working for the LLC, then you process their payroll, right? Then out of their income, they contribute. LLC will not contribute to the Roth.
Correct.
So the kid having an income, the kid has to contribute. Of course, it is a joint account because he's a less than 18 minor, but the kid has to generate the income. So there is no deduction for the LLC for contributing into the Roth, but there is a deduction for the LLC if the kid is said to be working for the LLC and you are paying him.
Next question. Joined a new company in the mid-year. New company is providing 401k. Before joining the new company, has regular IRA with $4,000. Incoming year, do we need to have only 401k? So it looks like he had an IRA from the old company, but in middle year, he changed the company and the new company is giving.
There is no IRA which is being employer sponsored. IRA won't be sponsored by the IRA employer. If you participated in the 401k in the earlier company, you contributed 4K, and the rest of the money, if your new employer is providing, you can contribute. Your limit is $22,000, say. You can contribute the rest of the money from the new employer. But if you're contributed only 4,000, there is no IRA because, once your retirement has been participated, it automatically disqualifies you from participating in the regular IRA.
Okay, so combined IRA and 401k, it cannot exceed 22,000.
Exactly.
Yeah, and so last year he had IRA half of the year and then 401k the other year. So coming year, if the 401k is more than 22, he don't need to do an IRA.
Yeah.
Okay, so the gift money can be received from parents from India account directly to our USA account.
Yes.
Okay.
Yes, and that's what I told you, right? If it is more than 60,000, you need to file a form number 35. Otherwise, you don't have to do anything.
Okay. So we have some more questions from the chat. Should we file FBAR on the fixed deposits with ICICI Bank?
The short answer is yes.
Okay. Okay, 1 second. The next question, we have a couple of questions. Okay, I'm having a LLC, which is a better way to save taxes, working as 1099 or W-2 on another company?
It's very generic a question in the sense of, the W-2 comes with the benefits. If you're a full-time employee, you get the vacation, you get, your 401k, you get your medical insurance and everything. So you got to really see that what is the extra benefit which you are really going to get out of your LLC. So I cannot really say that generically, okay, you work for LLC, you get more. Because what is the quantum of the money which you receive? What you intend to do with your LLC? That is what requires the consultation. I cannot answer generically which is better way. In a general sense, if your billing rate is more, where you are not getting any benefits from your current employment, then working for LLC as a corporation, you can tax plan. That much I can say.
Okay. So it looks like somebody got some LIC money from India. So LIC account amount received after maturity, is that considered as taxable income?
In USA, the answer is yes. The delta between what you paid and what you receive is income.
How do I open a Roth IRA for my 19-year-old daughter?
19-year-old is major, right?
Yeah.
You can open. Simply go to the financial institution, open a person's name.
Okay, that concludes all our questions. Thank you one more time. What an informative session. And if you have any other questions, you can go to ReddyCPA.com and make an appointment with Prabhakar. He'll be happy to assist you with your taxes or your any other advice. We are closing the session for today. Thank you very much, Prabhakar.
Thank you all. Take care. Good luck.
Bye.
Thank you, everyone.
Thank you.